Bonds are fundamental components of the financial markets, serving as key instruments for governments, corporations, and other entities to raise capital. Understanding bonds is essential for investors, policymakers, and anyone interested in finance. In this comprehensive exploration, we'll delve into the nature of bonds, their characteristics, types, valuation, risks, and significance in the global economy. A bond is a debt instrument that represents a loan made by an investor to a borrower, typically a corporation or government entity. When an investor purchases a bond, they are essentially lending money to the issuer in exchange for periodic interest payments and the repayment of the bond's face value, principal, at maturity. Bonds are a form of fixed-income securities, providing investors with predictable cash flows in the form of interest payments. Face value, the principal amount of the bond, which the issuer promises to repay to the investor at maturity. Coupon rate, the annual interest rate paid by the issuer to the bondholder, expressed as a percentage of the bond's face value. Coupon payments are typically made semi-annually or annually. Maturity date, the date when the issuer repays the bond's face value to the investor. Bonds can have short-term, less than 1 year, medium-term, 1 to 10 years, or long-term, more than 10 years, maturity periods. Issuer, the entity, government or corporation, that issues the bond and is responsible for making interest payments and repaying the principal. 3. Types of bonds. A. Government bonds. These bonds are issued by national governments to finance public expenditures, such as infrastructure projects, social programs, and debt refinancing. Government bonds are considered relatively low-risk investments, particularly those issued by stable economies with strong credit ratings. B. Corporate bonds. Corporate bonds are issued by corporations to raise capital for various purposes, including expansion, acquisitions, and working capital needs. Corporate bonds offer higher yields compared to government bonds but also carry higher credit risk, depending on the issuer's financial strength and creditworthiness. Century municipal bonds. Municipal bonds, also known as MUNIS, are issued by state or local governments to finance public projects, such as schools, roads, and utilities. Municipal bonds are often exempt from federal income taxes and may also be exempt from state and local taxes, making them attractive to investors in high tax brackets. D. Other types. 1. Convertible bonds, bonds that can be converted into a predetermined number of common stock shares of the issuing company. 2. Callable bonds, bonds that can be redeemed by the issuer before the maturity date, typically at a predetermined price. 3. Zero coupon bonds, bonds that do not pay periodic interest but are sold at a discount to their face value and redeemed at face value at maturity. 4. Bond pricing and valuation. Bond prices are determined by various factors, including interest rates, credit risk, time to maturity, and market demand. The present value of a bond's future cash flows, coupon payments and principal repayment, is calculated using the bond's yield to maturity, YTM, which represents the effective annual rate of return on the bond if held until maturity. 5. Risks associated with bonds. A. Interest rate risk. Changes in interest rates affect bond prices inversely. When interest rates rise, bond prices fall, and vice versa. This risk is more significant for bonds with longer maturities. B. Credit risk. The risk that the bond issuer may default on interest or principal payments. Bonds issued by entities with lower credit ratings carry higher credit risk and typically offer higher yields to compensate investors for the additional risk. Century inflation risk. The risk that inflation will erode the purchasing power of bond returns over time, especially for fixed-rate bonds with low coupon payments. D. Liquidity risk. The risk of not being able to sell a bond at its fair market value due to limited market liquidity. Less liquid bonds may require investors to sell at a discount to attract buyers. 6. Advantages of investing in bonds. 1. Steady income. Bonds provide a predictable stream of income through regular interest payments. 2. Diversification. Bonds offer diversification benefits when combined with other asset classes, such as stocks and real estate. 3. Capital preservation. Fixed income securities are generally less volatile than equities, providing stability to investment portfolios. 7. How to invest in bonds. Investors can invest in bonds directly by purchasing individual bonds from the primary or secondary market or indirectly through bond funds, such as mutual funds and exchange-traded funds, ETFs. Bond funds offer diversification benefits and professional management but may charge management fees. 8. Tax considerations. Bond interest income may be subject to federal, state, and local taxes, depending on the issuer's location and the investor's tax status. Some bonds, such as municipal bonds, may be exempt from certain taxes, making them attractive for investors seeking tax-efficient income. 9. Significance of bonds in the economy. Bonds play a crucial role in the global economy by facilitating capital formation, infrastructure development, and government financing. They provide governments and corporations with access to capital markets, allowing them to fund projects and initiatives that promote economic growth and development. Conclusion. Bonds are essential financial instruments that offer investors a way to earn income while preserving capital. By understanding the characteristics, types, valuation methods, risks, and advantages of bonds, investors can make informed decisions and build diversified investment portfolios tailored to their financial goals and risk tolerance. Bonds contribute to the efficient functioning of capital markets and play a vital role in driving economic progress and prosperity.